This is the current federal tax developments for the week of February the 10th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. This week we're going to take a look at a few things that happened during the week. We're going to talk about the IRS issuing final regulations that update the costs of cars that can be accounted for valuation-wise under the FAVR or cents per mile valuation method. OIRA completes one part of the review of 163J regulations, but apparently we're still going to have to wait some more to get an actual look at what they did because they started on a second project, and we'll talk about both of those. We have a case under conservation easements where the language in the easement ended up working against the taxpayer and denied the taxpayer a $16 million deduction. We'll talk about what the issue was there. And finally, we'll go over a minor thing here at the end that we are now going to be having to file all new 1023s. Applications for 501c3 status must be filed electronically. Officially, this is the case right now, although the IRS at the same time they announced that said that for 90 days we're going to still let you do paper. So let's say they told us in 90 days we will have to do this electronically. So we'll talk about that and get going. A couple things happening in the area this week. We have a couple of things going on. First, I do still have a couple of Cal CPA broadcasts coming up. On February the 12th, we're going to do the Real Estate Partnerships Get In, Get Out, Get Taxed program. That starts at 6 a.m. Pacific and 8 a.m. Pacific time. You can find the links to sign up on the website, on Cal CPA's website. Check your state society's website. They may very well have these links set up. And you also can check on the Current Federal Tax Developments website. You'll see my courses list. If you click there, you should be able to get the links to these Cal webcasts that are set up so you can go back, check what's there. After the 12th, we don't have a whole lot more left. On Valentine's Day, we do have that S Corporation's Advanced Issues course. This one will start only one course this time, 8 a.m. Pacific. We're going to do a single one, 8 a.m. Pacific on the 14th. And again, you can check that at Cal CPA's website, or you can go over to our website, check the 8 a.m. course. I think the 6 a.m. one's still up there, but it's been decided not to go forward with the 6 a.m. version. So we're going to do the 8 a.m. Pacific version. And if you want to get that, you can go on the website. You should be able to find the link there to sign up. But again, as I've always said, make sure you check your state society. State societies have deals with Cal CPA, and if you're a member of a state society, that deal with Cal CPA may make it more less expensive, shall we say, for you to show up and click the course with your state society. If you're a member of Cal CPA, obviously go to the Cal CPA site. That's where you can click and get it. Well, let's start with our first piece of information this week, development, and that was the issuance of final regulations, Treasury Decision 9893, issued on February the 5th, 2020. And these are final regulations on the use of various special rules for valuing automobiles. Now, the two ones in this case relates to the Fleet Average Valuation Rule, FAVR, and also to the cents per mile valuation method. Now, what we're looking at here is providing a method to value a vehicle when we're providing a vehicle to an employee and we need to value, how much is it worth, what we gave, what the value of what we're letting them use. And the fleet method is for larger fleets, under certain conditions. Cents per mile valuation method is another method that can be used in limited cases, but in both cases there's a limit on the cost of the vehicle, or I should say the value of the vehicle, that can be involved in this particular treatment. Both of them had caps. Those caps used to be far lower. We used to have a much lower cap, but they were changed by the Tax Cuts and Jobs Act. Prior to TCJA, our limitations, they were inflation adjusted, but they had been at basically $12,800 for a cents per mile valuation method vehicle and $16,500 for the FAVR, the Fleet Average Valuation Rule vehicles. TCJA greatly increased the, quote, luxury auto rules. We call them that, right? Those are limitations that you have for computing a deduction for the depreciation on a car. Well, that basically, 280F's rules were the reason why we had these low limits here. In essence, we didn't apply this, quote, non-luxury automobile. Well, now they've gone back and rethought about it since we've seen some major changes, and they're going to jump these numbers, and actually fairly significantly. The IRS had announced a while back that in notices 2019-08 and 2019-34, they had issued an announcement. 2019-08 had essentially allowed you to apply these rules at a much higher cost level, up to $50,000 for 2018. And the later notice, later in 2019-34, issued numbers for 2019, which increased for inflation, but definitely much higher numbers. Notice 2019-08 told us that the IRS planned to issue regulations that would go back and update to show these higher numbers, because the regulations have those lower numbers hard-coded into them. And for that reason, we needed a new regulation to get these done. We now have those higher levels. They've been made part of the regulation. As I said, of course, we had notices 2019-08 and 2019-34, and those notices gave us the basic rules. So this is probably not so much a change as it is we've now locked things in. You won't need to look for a new special notice. You're going to be looking for, just for 2020, the inflation-adjusted amounts for these cars when they release that sometime during this year. But otherwise, we're not going to be looking for a new notice to extend the treatment one more year. We're going to be fine with that. The IRS had issued these proposed regulations back in August. They had received no comments whatsoever. So if you looked at the proposed regulations when they came out back in August, nothing's really changed of any significance. They also have here a couple of special transition rules, which you might not have been aware of. But because this number is so much higher, they decided that it wouldn't really be fair if you got the car and you'd given it to the employee in 16 or 17. So the car came into service before these rules were allowed, and both of these looked at the initial time you put a car in service. They said, well, it's not really fair to take these cars that that didn't qualify under the much lower level. Now that the level's gone higher, they do. So for 18 and 19, there's a pair of special rules that let you start valuing cars using these methods if you choose to do so, if the value of the car as of the beginning of the year is below the limit. Now, these will not count in 20. In 2020, we start going back to the same old rule we had before. You had to start using these methods with the car when you started providing it to the employee. You have to meet all the requirements and all of that. So we go back to the standard rule in 2020, except now having the much higher number. I'm sure the idea is if you didn't change for those pre-18 cars, if you didn't decide to go back and change in 18 or 19, you just aren't paying attention, and tough luck, you lost your chance. But otherwise, if you have been, yes, we do have that special rule. So it's a possibility if you want to use it. Next up, something we've been waiting for a long time is still not here. But at least we're a little bit closer to getting it here, at least apparently. The Office of Information and Regulatory Affairs this week had two different status updates on their regulatory review page. First, we had a notice that the final regulations under 163J, that particular regulatory review had been completed, and then 3 days later, we had a notice posted that they were beginning review of new proposed regulations under 163J. 163J is the section that has the business interest limitations. 30% of what's, for the moment, a tax-based version of EBITDA, earnings before interest, taxes, depreciation, and amortization. It will eventually convert into just earnings before interest and taxes. Not depreciation and amortization won't be in the mix. That's in a couple of years. That 30% limitation, I should say, today it's earnings before interest and taxes. It will go to full earnings before, I should say, it's earnings before, yeah, got that right to start with. Right now, we ignore all of those, right? So we begin to add back depreciation, add back amortization, ignore those. Eventually, we won't be able to add those back. That 30% obviously is a problem if you have a highly leveraged company or you have a highly leveraged operation. And let's think for a second about a lot of real estate investments. Well, yeah, I mean, people put as little down and they're highly leveraged and they tend to throw off losses every year. And part of those losses are the interest. Well, if we're limited to 30% of earnings before interest, especially before taxes, before interest and taxes, and especially before depreciation, we have that. Well, that gives us some room. But when depreciation comes out of that mix and it's just for earnings before interest and taxes, that's not going to leave any room at all for those real estate investments. So this is a potential problem. Now, there is an exception if you are below $26 million, that's this year's adjusted amount, in average revenue for the prior 3 years. but that does not apply to a tax shelter. And as we discussed in the past, the syndicate rule causes us some nightmares there if you're in real estate. Because the syndicate rule says if more than 35% of the losses are allocable to what are called limited entrepreneurs, which for practical matter means for your LLC, the people that put money in but have no right to be participating in management, they're not materially participating, that group, then you're considered to be in this class of tax shelters, which can't make use of the 26 million limitation, which means 163J apparently would apply. Now, there's been a lot of comments asking the IRS to write some sort of exception for that kind of structure because that wasn't what Congress meant. Well, we'll see what happens. The final regs went to OIRA. These final regulations are based on proposed regulations that came out back in November of 2018. So, they've been around for a while. They had been promised, Assistant Treasury Secretary for Tax Policy, David Cotter, had said at the AICPA's conference on taxes that essentially we should have this, have these regs by the end of January, these final regulations. The problem is, of course, we got to the end of January, they're not there. So that's the issue. These final regs are rumored to have a bunch of potential changes. Some of these changes that we've been told, we got some confirmation about what would be changed, right? We expect a change in the definition of interest. That's important because the IRS had a very broad definition and included a lot of fees in the definition of what was interest. So we're told that's going to be, the list is going to be shortened up. We just don't know how. We're also going to address computation of adjusted taxable income. There have been some concerns there that you couldn't add back interest that got, or depreciation and things that got rolled in to cost of goods sold, other issues in doing this. That was considered to be a problem there. There's some issues there technically. And they also are going to do something with the small business exception, and so that means we're all crossing our fingers. That means doing something about the syndicate rule to see if they can decide how to write the tax shelter option to include, to go after things that appear to be structured in some ways that's not traditional, rather than just your standard real estate investment partnership. Now, again, those real estate investments, if they are covered by this, could get out by electing to be treated as basically an electing real property business. But in that case, they have to use ADS on all their buildings. Not so bad for buildings you acquired after the Tax Cuts and Jobs Act took effect, because now our ADS life is 40 years instead of 39. If you are, if you have commercial property, it's 30 years instead of 27 and a half if it's residential. But for anything you acquired before 2018 or before TCJ, then your ADS life is 50 years on those commercial properties, 40 years on residential. The good news is we have been ruled we don't have to do a change of accounting method type change. We just do a change of use. So we just take the remaining unadjusted basis over the new remaining life. But it's still going to slow it up quite a bit for those older ones. That's bad, maybe not so bad. What's also could be bad would be that we'd lose any chance of using bonus depreciation. And there are things we can use bonus depreciation on in real property. Most importantly would be if they actually fix the problem we've got here with qualified improvement property, allowed that to be actually written off over 15 years. That would qualify it for bonus depreciation, which qualify it for complete write-off. But if you made the ADS election, all of that's out the window. You're going to be doing that over the 40 years or the 30 years. You're not going to be able to make use of it. Now, as it stands right now, you're going pretty close to 40 and 30 years anyway, but that might change. At least a lot of people are hoping that changes. The final regulations went to OIRA on December the 17th. They came out, according to the website, January 31st. Now, this was interesting because there was a meeting scheduled with Sempra Energy on February the 4th. That meeting did not take place in the same day OIRA changed their website to indicate this thing had all freed up on January 31st. We're not sure what, if anything, that means, why the meeting wasn't held, and what the impact might be. But in any event, we got that. Now, the problem there is, of course, that meant that it sat at OIRA for about a month and a half. In the interim, while those regs were there, Treasury we had an announcement made at As I recall, it's a DC bar conference made by a Treasury representative. In this case, the representative was Brian Rimke, attorney advisor for the Treasury Office of Tax Legislative Counsel. And at a DC bar conference, he indicated that the IRS was going to issue the final 163J regs at the same time as a set of proposed 163J regs that covered topics that weren't covered in the original proposed regs, and there's a bunch of those. Well, here's the catch. Nobody knew that there was supposed to be a set of proposed regs sitting out here somewhere, or that they were going to go with these finals. Well, now we get this notice. Everybody's wondering, well, what does that mean? Were the proposed somehow sitting inside the finals and nobody ever told us? No, it turns out not the way it was. The proposed regs went in on February 7th, right? And because of that, if they stay in for the same amount of time, then we're going to be looking at the final regulations coming out likely somewhere just after the March 15th filing deadline, if it was the same time, and that would be the March 15th filing deadline for partnerships and S corporations, or at least probably well into this month. We certainly don't expect OIRA is going to complete the review in 2 days and send it back to Treasury. We'd love it if they did, but I doubt it's going to happen that fast. I think they're going to take a look because there are a bunch of other projects that are at OIRA from Treasury as well. And unless they've decided to put this on the fast track, which then raises the question about why the final regs didn't get fast tracked that quickly. But unless they put the proposal on the fast track, then we may be waiting. So the problem is we don't know what these regs are, and we still don't know for sure, are we going to be able to use them for 2019 retroactively? Because if we are, then maybe I don't want to finish up a return that might be impacted by these regs. And maybe I want to, see how much time I can buy. That's great, except, there are other issues and reasons why, especially partners and S Corp shareholders, the pass-through people who are going to be most likely impacted by this, are not going to be so thrilled to just keep waiting because you're still trying to see how this thing works. Will be an issue, though. The proposed just went in. We'll have to see how long it takes us to get the finals. Next up, this is a case of a problem with documentation killed a deduction. This is the case of Railroad Holdings, LLC versus Commissioner, Tax Court Memorandum Decision 2020-22, issued on February the 5th. This was an attempt of a taxpayer to claim a deduction under Section 178 for a conservation easement, qualified conservation easement. Conservation easement is one of those unusual cases in the code where you can give a partial interest in a piece of property and still claim a charitable deduction. Generally under 170, I cannot give a partial interest in a piece of property and claim a charitable deduction. I have to give a complete interest to the charity. But in order to encourage people to make these conservation easements, Section 170H allows, for a qualified conservation easement, a taxpayer to take a deduction even though the taxpayer still holds the land, still holds the real estate, still holds whatever is subject to the easement. So as the use of it, there just are restrictions on what can be done with it. This is what was going on in this case. Taxpayer was making a contribution to an organization that was an easement, a restriction on use of the property. Now, and the catch is it has to be guaranteed in perpetuity. Okay, so the problem is that's great. I can give. Let's say I've got a building. I can give an easement on the building. But the problem is, what if, in this case, I'm here in Phoenix, the city of Phoenix or the state of Arizona decides that they're going to put a freeway through that area where my building is, and they're taking my building. Well, I can't stop them from taking the building. And obviously, if they take the building, that easement is going with it. It's gone. The charity is going to lose the right to the easement. So the issue is the regulations recognize that we can't guarantee that there will not be an involuntary termination of the easement during, let's say, a judicially ordered sale. So what the regulations require is the regulation 1.170-14G6II, I always love citations like that. We get things like that. Says that effectively, okay, we understand this, we might lose, you might lose the property. So if the property is sold, right, involuntary sale, you will still be deemed as protecting the interest in perpetuity if your deed provides that when it sold, the proceeds equal to the proportion of the value of the property at the date of donation that represented the easement is paid over to the charity. So we divide our proceeds by using a ratio. So for instance, if I claimed a deduction for a conservation easement and we had determined that the easement was worth 10% of the value of the property on the date of contribution. Well, I would have to assure that the charity, when we sold the property, got 10% of basically the net proceeds of the property. Proceeds, not counting, because again, I got a full thing, I can't count debt, but basically got, 10% of the proceeds. They were able to get that money. If I don't do that, then the theory is it's not protected in perpetuity. Well, the problem was this particular regulation, or this particular deed, was worded a little differently. And what it said was the fair market value of the right and interest shall be equal to, and they go into that, the difference between fair market value and, the fair market value of the property as a whole, the fair market value of the interest, right, of the conservation easement, at the date of donation. But then the language about how to divide things up says that they will get at least the value equal to, that original idea. So if I got $1 million deduction on a $10 million piece of property, that 10%. What I'm saying now is that the way this was worded, what it really said was, all it said in the end was the charity would get at least $1 million. But it didn't require us to give the charity 1/10 of the proceeds. And now that's a problem, because the IRS says, well, guys, this is not, in line with the reg. The reg says you had to, in essence, the charity has to gain from the appreciation, and the way you've got this written, it didn't. Now, the court seemed to believe, and I suspect for good reason, that the language had been drafted by the charity, and that the charity had presented this language to the donor. And the court said that's all well and good, but not so great. The court said fundamentally, yes, this at least language, what's there is, if I read this thing, all it says is we're going to give the charity that $1 million. We're not going to, nothing in here says I give them 10% of the value. Now, the taxpayer tried to argue, well, look, you're missing the point. It said at least. So obviously, we just go ahead and give them the full 10%. And the court said, no, it somehow saying you're going to get a value that's $1 million, period. That's what you'll get. And then just simply putting the word at least in front of it without having any mechanism for getting it higher doesn't solve the problem. The only amount that they have to get is that $1 million. They get that $1 million. That's totally in line with what the deed says. They said that's what they'd get. We're going to assume that's what they'd get because, the other party would very well could say, look, the deed just says you get $1 million. And I get the 99 million because it's gone up in value 10 times. I get 99 million, you get $1 million. You don't get 10 million out of the 100 million we sold it for. So the court said, yeah, that's it. Well, the taxpayer came back and said, well, the charity signed a statement that said it was their intent, that this was supposed to qualify and therefore they were supposed to be able to get the 10%. Well, the court kind of said, look, it's really not your intent, it's more the donor's intent. But secondly, you've never told us anywhere that this was a drafting error, that there was some mistake made. You're not saying all this. You're saying, this is what we meant to do, but you didn't say it was drafted wrong. Nobody's claiming this is a Scrivener's error, and nobody said that anyway under the state law in question that we could use outside evidence to prove that this at least really meant the 10% of value. Is that there's no proof that could work in the state, and state law would control here. And number two, nobody's actually told us about any such evidence anyway that would suggest the 10%, that would suggest the ratio of the sales price would hold instead of this number that appears to be just what was given. Finally they said, well, look, you missed this thing. At the very end, we have language saying the intent of this is to interpret ambiguous items, to be in line with the requirements of 1.170, the regs. And the court said, well, first thing is that section, if you actually follow it carefully, referred to a different issue. In fact, that particular section they were trying to qualify under was, a totally different issue in this case. They were saying that basically it was a conservation purpose, that the purpose was conservation. We'd interpret it that way. It didn't really refer to protecting in perpetuity clause. Number two, the court said, we're not going to let you use a savings clause in this sort of structure. That is, you can't write a document that is totally at odds with what the law requires, but then have a thing in the bottom and say, oh, by the way, if it turns out that this doesn't comply with the law, then we'll obviously follow the law. The court said, no, that goes against policy. In reality, the only way this would ever be enforced under the law, as opposed to the way this is written, is if the IRS was there on the date of the sale and forced you. If nobody's looking when this, and nobody's looking at that sale, then it's only going to be the million, not the 10%. Actually, 60 million in this case, but who cares? 15 million difference, no big deal. They're saying, no, it wouldn't happen. And more to the point in this case, you think about it, the IRS has to challenge this like they are here today at the time of donation. Right? If the savings clause works, there's no point for them to challenge, because they challenge, savings clause is now triggered, no taxes collected. There's no incentive for the service to waste resources they're trying to use for enforcement to go chase these things down that have no impact. They can't have an impact. As soon as they show up, the issue goes away. The court said, no, we're not about to say that will work. You can't just put these savings clauses in documents and say, aha, if you catch us, then we'll follow the law. Saying, no, we're going to assume you're going to follow the document. And they said there is almost no chance a state court would have enforced this under the rules of the IRC. They probably wouldn't even understood the issue. So the bottom line is you can't do it. Like it or not, you lose the entire deduction. The language did not comply with the requirements in the regulation. Tough luck. This was a $16 million deduction down the drain. If you are doing conservation easements, the IRS is paying a lot of attention. And this was not. There's that whole other category of the abusive ones, which is a whole nother nightmare. The IRS is going after that these days, where you're told, oh, put $100,000 in, and magically you're going to save 40. You put $100,000 in, and we're going to reduce your taxes by $400,000 1 year later, when magically that item goes from being worth the $100,000 that you put in to being worth some $1 million in value for a donation. It's like, yeah, that's abusive. It's not that type. This is just a straight up contribution of an easement. The catch is you've got to be very, very, very careful to make sure that the language of any deed, the restrictions, are in line with what's required. In this case, tough to know why they did it this way. Was it just a dumb mistake? Was it intentional? Were they trying to pull a fast one? It doesn't really matter. The courts are very picky on this. So if you're going to do an easement, make sure that you have it looked at. And in this case, they had, it looks like the charity was doing these documents, which may very well mean a promoter was kind of in the middle of it too, I wouldn't doubt. But the problem is, you need to have your own counsel review it, and counsel that knows this and will be skeptical. Again, a $60 million deduction lost, and if I believe the plaintiff and I believe if I believe the charity, they would have accepted a properly worded document. So why wasn't it properly worded? Either we're trying to pull a fast one, or we simply flat out didn't know what we're doing. That's kind of the two options you got for this. Next up, change revenue procedure 2028-8, I should say, not 2028, but 2020-8, issued on January 31st. Form 1023 to apply for your exemption for tax-exempt organizations, right, under 501c3 of the Internal Revenue Code. Now, all of those must be processed online electronically. The IRS has been moving that way. They told us last year they were going to do this. You have to pay a fee through pay.gov and submit your documents. You can pay through a bank account or credit card, right? 1023 Easy previously had been accepted only electronically if you filed that. Now all of them are going that way. And as I say, it is effective now, sort of. The catch is it took effect as of January 31st, But for 90 days, the IRS will ignore the requirement. So that means that really we're looking at a cutoff date that effectively looks to be around April 30th. So up through April 30th, you can still file a paper 1023. After April 30th, the IRS will reject paper file 1023s. So you're going to have to file electronically. Now, a couple of issues came up, and there was a letter that was written to the IRS that came in from the law firm of Jones Day. And that letter asked a couple of questions as the IRS was doing this, saying, hey, we got a couple of issues we want to look at, right? How does this work? First thing is, after we get done inputting all this stuff into your screens, can we actually download a copy of what we just said? I mean, we'd like to know what was in the document, especially if you come back later and challenge our exempt status by saying something was wrong with it, or you decide that you're going to deny it for some reason. You know, we'd like to know what we said. And they said, yes, the system will allow you to download the submission and file that away. So that's okay, that's good. Second problem was, if you have a long, complex submission, there are size limits for what can be uploaded with this particular document. And they're saying, look, we have applications that have a lot more than can fit inside the restrictions that you're allowing us to use for the online application process. So IRS, how do we deal with that? If I've got a document that's a 1023 that's too complex to work through this, I need to send you other documentation. Well, this gets a little interesting. The IRS says, well, if that's true, go ahead and do the 1023, right? But then you're going to hold back and you're going to submit as many documents as you can. But then the ones you can't submit, you're going to call them and, call the IRS, and the IRS will basically arrange for you to fax them the other documents, and then you hope like mad the two get linked up together. So we have that size limit for the access. As I said, this is coming up. The other issue that was mentioned, and one of the authors of the Jones Day request letter was basically citing a Tax Notes Today federal article, noting, this is Gerald Griffith of Jones Day. He pointed out that one thing that seems likely is going to happen with this is third parties will probably be able to suggest, like GuideStar and the like, will be able to go to the IRS eventually under this program and get a copy of your 1023 without you knowing the copy's been issued. Up to now, they would have to contact the charity to get a copy from them, and yes, you needed to provide it, but you knew that those organizations had gotten it, that, let's say, a reporter had picked it up, and that something might be coming. Now they're saying this document, you just have to assume that everybody in the public's going to read it, and you may first find out that the public got the document when you read about your organization on the front page of your newspaper. Wall Street Journal has a story about you today. Isn't this wonderful? All those sorts of things. So there are a few things going on here. Ultimately, the takeaway from this is, if you have an application 1023 and you're going to do it, you want to do it on paper, you still want to go that route, you're going to start get it done now. By the time we get to the end of tax season, you're going to be at the very end of the 90-day period, and eventually we're going to go to full electronic filing. So be aware of that. If you do have one you want to get done, I would probably suspect that if you had a larger one that is going to have to go the fax route, and that just looks like a problem waiting to happen as the pieces there don't get attached to each other. I would probably say you want to try to get that thing done before the drop dead date of around April 30th shows up, and you're going to have to do the electronic. Obviously, once we get to April 30th, any future applications will go electronically. We can hope the IRS somehow expands that particular attachment field so that larger documents can be attached and the full thing can be submitted online rather than halfway that it sounds like a lot of larger applications we'll have to do now. But we'll just have to wait, see how it's coming. The electronic 1023 is here. So if you're in that area, you practice that area, you just got to be ready to start working with it. Well, as I tell you about this time of year, this is the time of year where we're pretty much done with our live CPE. I gave my last in-house session of the season last week. I'm still doing a couple of webcasts here coming up, both the Cal CPA ones and some others. But again, just a few more things left. Really, after this coming week, not a whole lot's going to go on in CPE. Right? We're going to have a few little things. I think Cal CPA will have a couple of broadcasts in the period from February 15th until April 15th. I think there are like 2 broadcasts I'm involved in some way, shape, or form that are broadcast in that area. Again, don't expect a whole lot. We know that's not what you're going to be thinking about this time of year. But keep your eyes open. Your state societies will start posting their events for this year. Also, if you want me to come and talk to your firm, your company, you want to do that, you want to see about arranging having us come out, now's the time to get on the calendar. Days in November are filling up. Actually, they're getting close to filled up, but we're getting there. You know, the days that you might like to have us out there, which probably be between October 15th and December 15th, those days are filling up very, very quickly. So if you want that, now's the time to call and get that together. You can work with your state society. You can call us directly, and we can try to make this happen. But yeah, we're getting into that time frame. If you want to go into January, you have a little more time probably to play with because not as many people want January sessions. So if you're of the kind that would like to do that, especially like a tax update in January on the theory that, hey, never know. Congress Congress passes things late, so maybe we need a January session. I know I have firms that have done that for a number of years. Their idea is no point in doing it for then, right? It's one idea versus the other of, yeah, we might as well catch up on what we can rather than be finding out about things a week before we start trying to do something. Let us know that's coming up. We're there. This has been the Current Federal Tax Developments here for the week of February the 10th, 2020. You can follow my updates online at currentfederaltaxdevelopments.com. If you have any questions or comments, send them to me at edzollers@currentfederaltaxdevelopments.com. My Twitter handle online at edzollers. I also follow discussions on the subreddit /r/taxpros on Reddit. Also, I'm involved in the Tax Talk group of Cal CPA. So if you participate there, I'll take a look. I see some questions there. Also, we'll check in questions on the Connect sites on the Arizona Society of CPAs, the Minnesota Society of CPAs, and the New Jersey Society of CPAs. So if you have some questions there, you can post something on those Connect groups. And if I think it can be of help, I'll try to jump in on those. Otherwise, another week coming by. We'll see what the IRS comes up with this week in terms of any guidance. We do have a number of projects at OIRA, so we're probably going to have some regs coming out, proposed regs coming out over the next few months, next month or two. Eventually, the 163J rules will come out, so we're certainly looking for that stuff going forward. Otherwise, I think we're about to get to the serious part of tax season. Remember, February 15th is coming up. That's the day that the brokers are supposed to have consolidated 1099s out. And I don't know about your firm, but for my firm, that's when we see the super acceleration of the number of returns coming in the office. And I suspect that's going to be true for your firm as well. So hopefully you survive the upcoming tax season. In any event, we'll still try to keep up every week here and give you at least some update on what's going on in tax laws. So be sure to join us back here next week with current federal tax developments.